To our first session of the day, the first panel of the day on AI for credit risk management, banking and finance companies. Now, before I call on stage the honorable panel members who are experts in this domain, I would like to highlight few points which this honorable panel is going to discuss. How AI-powered tech is transforming the credit risk process, applications for AI in credit risk management, leveraging real-time data and analytics to augment the decision-making process, and many more. So now, ladies and gentlemen, please help me welcome with the biggest round of applause our honorable panel members in the order of the sequence. I would like to first call on stage Mr. Shardul Kadam, CRO from Fedbank Financial Services. A big round of applause to Shardul. Shardul, welcome to the stage and please have your seat. Joining next, ladies and gentlemen, we have Mr. Sachin, Bawari, Head Risk Lending Business from Khatabook. A big round of applause to Sachin. Sachin, welcome to the panel. Please take your seat. Joining next, ladies and gentlemen, we have Mr. Saurabh Srivastava, Head Credit Risk from Unity Small Finance Bank. A big round of applause to Saurabh. Saurabh, welcome to the panel. Please take your seat. Joining next, ladies and gentlemen, we have Mr. Anant Deshpande, co-founder from FinBox. A big round of applause to Anant. Anant, welcome to the panel. Kindly take your seat. Joining next, ladies and gentlemen, we have Mr. CMA Srinivasaraghavan, CRO from Arman Financial Services. A big round of applause. Please take your seat, sir, and welcome to the panel. Joining next, ladies and gentlemen, we have Mr. Alok Pathak, CRO Utkarsh Small Finance Bank. A big round of applause to Alok. Welcome to the panel. Please take your seat. Joining next, ladies and gentlemen, in this panel, we have Mr. Nirav Shah, CRO Adhaar Housing Finance. A big round of applause to Nirav. Nirav, welcome to the panel. Please take your seat. And now, ladies and gentlemen, the honorable moderator of this panel. A big round of applause. Welcoming on stage Mr. Sreejay, Associate Director, Data Analytics from Altair. A big round of applause to Sreejay. Sreejay, welcome to the panel. Now that's Sure. So Sreejay, all over to you for this fantastic panel session.
Thank you so much, ladies and gentlemen, and welcome to this great event. The key aspect of any credit risk analysis would be understanding how data can be used to make it better, right? So obviously, managing credit risk is a daunting task, actually. I would rather call it as a challenging task for people managing risk across in a bank or a financial service. It's all fine when things are really good, if the economics are really good in the market and the lending cycle is in the uptrend. It's easy to give more loans. But as the market deteriorates, or if the moment there's a volatility in the economics, the things really change hard. And in no time, you see loans piling up, NPAs going up, skyrocketing, and the portfolio is going for a toss. So obviously, that is where a data-driven approach with AI actually helps a lot in credit risk management. Some of the tangible benefits of having an accurate credit risk management, as far as I know, would be a reduced in losses, a reduction in operational costs, and obviously a favorable, capital requirements. Having a data-powered or a data-centered, AI-powered credit risk management actually enhances, the entire process for a long run. Ideally, it actually helps the risk management team to analyze the customer, see his profitability, understand his behavior, churn out through a huge amount of data, try to understand what the customer is actually doing, his spend pattern, what are the macro and microeconomic factors really changing the dynamics, etc. So with AI into picture, the different aspects of AI, credit risk management actually has a long, good future ahead of time. So let's discuss more about this in this panel discussion. I have some great leaders, some distinguished people today who have been in this industry for a pretty long time, more than 2 decades on an average, and they have a huge amount of experience working with the credit risk management platforms and the business as a whole. Okay, so since we already have the, we already had, the introduction of the gentlemen, all of them here, I would rather take the questions directly from my neighbors, actually. So the first question I would ask is to Mr. Sachin. The question I would have is, so based on your experience with credit life cycle and associated risk, how do you think AI-powered technology is transforming the credit risk?
Thanks. Thank you for that. In my view, currently, let's look at it this way, that in the credit life cycle, right from origination to processing, underwriting, dispersal, and then post-dispersal collections, and then loan maturity. At each stage today, AI has embedded its footprint. Whether you call, at the origination stage, the application journey and the acquisition journey, both are enabled by AI in the sense that it's aiding targeted marketing to the right target audience. It is also, enabling easier application journeys, right, with minimal documentation, right, where customers using the India Stack and other digital ecosystem enablers are having to, provide or input very little information, basis which, information is pulled, read, processed, and therefore decided upon, right decision. And all this is being enabled by certain pillars of data pipelines, certain enablers of massive amounts of data digitization, which has happened over the last 1 decade, and therefore leaps in intelligence of the artificial kind, which really is, aiding faster, more accurate decision making, and therefore is also resulting in better credit risk management, better customer experience, and better lifetime values, if you were to say so, from every customer, given that if the process is easy, the risk is contained, and the experience is good, there is a repeat cycle with the same customer, and therefore brings down acquisition costs, keep credit risk costs in containment, and therefore increases the lifetime revenue from that customer. So yeah, thank you.
So Alok, based on your experience, how do you take this in a different dimension? The same question regarding your experience with credit life cycle and associated risks.
So definitely, see, the kind of data what we have seen flowing. So the major challenge what banks, especially I'm talking about banks because my background is more from the banking side, is the quality of data. Like what kind of data we are having. So like we have a lot of legacy things and all. So the good part is now after like fintech and lot many NBFCs who are expert in this line, so they are giving a lot of feeds to that. Now the problem is for the plenty actually. So you have, like I have seen the scorecards, people are using 80 parameters, 100 parameters. Now the challenge is how to understand that part. If you start using all the parameters for the scorecard purpose, or maybe using AI that, okay, this parameter is affecting more for this particular purpose. Creating a score by all the parameters is always a challenge. So when I'm talking about the AI, definitely it's a very big tool for our decision making. You can say we can get the whole X-ray of my entire customer database. Having said that, if at all you're not applying your mind, in the sense that which geography you're talking about. So although geography will tell something about one type of customer, the same type of customer at different geography will not work. Correct. So how you are using all these parameters, how you are continuously tweaking this, because scenarios are changing. Maybe pre-COVID, one type of events were happening, one type of geography was performing in one manner. Maybe post-COVID, scenarios completely changed. I think everybody will agree that within no time actually that the behavioral change. Now, if you are using all historical data and you are not continuously applying your current problems, your current, whatever changes has happened, it will not work at all. At the same time, if I start using my COVID delinquency data with my current model, again you will be failed. So the idea is AI is very important because whatever Excel sheets and especially nationalized bank and banks who were like traditional bankers were using Excel sheet, which is like how much you can rely on that. So now we are getting a lot of digital source where directly from source information is coming, right from Adhaar, then your now account aggregator. Actually, it's a I will say it's a boon for the entire banking industry, the kind of data what we are going to get, the kind of actual data. Because otherwise what one person has entered, that has become data for the entire world. So now you are getting data which is actually backed by or maybe that directly taken by the source. So that is a major change what I see, especially as on date. And the kind of computation what you are doing. So like today, if I want to tweak one particular thing for my credit underwriting, now it becomes very easy because I can get an immediate result for that particular change. But if I talk about like 10 years before what we were doing for the credit purpose, so I think it was taking, it will say that, okay, we'll take 3 months to create something, then further 3 months to take some decision, then again back testing will take your years. So all those scenarios will change.
Correct. Correct. So, Mr. Raghavan, broadly, where do you see applications of AI across credit risk at this point of time?
Good morning. Sridhar, and before going into that, I had been in the pre-AA period and also in the post-AA period. The company wherein I am working right now for the last 1 year, Arman Financials, is fully digitalized one. It's more of a fintech company, though it is not called as a fintech company as such. And they are mainly into AI and ML applications. As Alok was rightly saying, I was the person, when I joined the company, put in around 110 parameters into this application for testing. And let me say that in split of a second, within 5 minutes, 10 minutes, it throws out the data. I'm surprised how it is being done, but having said that, that is the way it is. I'm into a microfinance MSME company, wherein the monthly, we are into 9 states, and the monthly disbursals happening was around about 100 crores till March last year. Immediately after this application was started using, probably in April, May, the disbursals went up to 150 crores. No change in the skill set, only the applications were used, no change in the places and all that. Nothing, everything is same. The only thing, the potentiality of the AI applications helped us to improve the disbursals from 100 crores to about 50% increase, which itself speaks of everything. Maybe due to touch, maybe due to productivity. And another important thing, another important thing is on the collection efficiency also. Earlier, it was very difficult for us to really understand which area we should pump in, because we are into Uttar Pradesh, East, West, so many inner areas, Bihar also. Okay. We don't know what the places like. Now, the full mapping is done through the application itself. So, in a way, what I'm trying to say, and that has helped the collection efficiency pretty well. Because the microfinance lending is practically for 2 years, not more than that. But having said that, the collection efficiency, which was around about 96.5%, for the present has improved to 98%. So this has also helped. Okay. Underwriting and the collection efficiency has been done through the AI mechanism at this point of time. And in fact, we are a listed company. I don't want to market here. I'm just saying the share prices, which was 950 at that point of time, today it is 1,400. I'm talking about 1 year time. Okay. Okay. But having said that, what I'm trying to say is that the applications use has been plentiful, mainly in the underwriting, mainly in setting the exposure limit. We have 2 companies. One is the MSME, that is in the high value lending. One is in the microfinance lending. Okay. But the microfinance lending has been pretty difficult one. But having said that, my job has become easier because of, as a chief risk officer, has become much easier because of the underwriting and we can fix the exposure norms. We can probability of default also we are able to say which area it says that this area there will be default, and it happens.
Okay.
To that extent also, I'm saying from the practical point of view. So these are all, very many things are there, but time constraint, I'm not looking into that.
Sure. So Nirav, what would be your views on the applications of AI across credit risk at this point of time?
Yeah, good morning, everybody. So, please excuse me. So, I am a man of basics, so I would like to start with basic.
Sure.
Like, we all know corruption and bribery is not good. But as in a fraction of a second, when you are caught jumping a signal, the first thing you will do is you will try and bribe and escape. So, हम भूल जाते हैं. So that is why reiteration is very important. So reiteration in terms of what is credit risk management? It's maximizing risk-adjusted returns.
Correct.
So इसमें हम maximizing returns भूल जाते हैं. So we tend to forget maximizing return, and risk is the thing that comes on the top of the fraternity which is sitting over here. So to start with, if we start with this basic in mind, the objective of credit risk management, which is maximizing the risk-adjusted return for your organization. How we used to do it traditionally is basically it was simple. We used to define policies, we used to define DOAs, we used to underwrite high-value cases, we used to be part of the credit committees, and that's all. Because nothing more than that, because we did not have any tools, neither we had a data. What has changed is now we have data, we have capability and capacity to manage this data, and we have tools to use this data.
Absolutely.
Now, with this in mind, if we move forward into credit risk management, right from identity, right from to underwriting. So identity, which was only gathering address proofs and ID proofs, it has changed to verification, database-based verification, and not only addresses and IDs. It also includes your employment. It also includes your stability. It also includes your stability in terms of job, in terms of mobile number, in terms of your email ID, in terms of the banking transactions and stuff like that. So this is identity purpose. Everything has changed. Coming to underwriting, again. Which was basically again taking papers and going through the papers and identifying the risk. Now all those papers, the data in those papers can be digitally captured. Balance sheets and financials can be analyzed. Bank statement can be analyzed. Even intention can be analyzed by psychometric test, and even the decisioning part can be answered unbiased by models in place.
Okay.
So Part A, identity. Part B, underwriting. Part C, so if you are into mortgages, the valuations, also there are tools available, data available. You can do desktop valuations. You can get all, if you are valuing property A, and you can at the same time, you can get all the properties nearby, how much they are valued, and obviously the model will answer you whether you are doing the right collateral valuations. To legal search. So everything has been available in terms of data. Everything is available to use, but then now what we have to then understand is what is relevant for the product that you are selling. Because with different kind of customer base, different kind of ticket size, different kind of tenor, all may not be relevant because there are a lot of noises, there are a lot of things in terms of data and things are available. So making things relevant, thinking from the perspective, and again, with all this, your definition for credit risk or the objective of credit risk has changed, which was maximizing returns plus seamless customer journey plus kind of unbiased approach to the customer. So these are also part of, so everybody you want to capture the market, and to capture market you have to ensure that seamless customer journey is possible, and this is only possible with the help of data, AI and analytics.
Okay.
Yeah, thanks.
Thank you so much. Anant, I would like to ask you how AI has powered credit, how AI powered credit has helped onboard customers faster. So how does onboarding become seamless now with AI in picture?
Yeah. So I think first of all, I'm in this August company, so really grateful for sharing the space with you all experienced people. I represent mainly the fintech SaaS here among the heads of risks and heads of business. And FinBox, the company that I represent, has operated in the area of unsecured lending. And within unsecured lending also, small ticket size lending. And this is where I think clearly there has been a paradigm shift. 20 years back, if we would have seen the best of the NBFCs or banks who do small ticket size lending, they would perhaps have a 1,000-member team doing 10,000 loans a day or in a week. And while today we see lending become so digital that you could be doing 50,000 loans within a single day with maybe 30-member team.
Correct.
So that's the change. The other thing that has happened is, of course, ticket sizes have come down. Earlier, if typically in consumer or MSME, you would have seen average ticket sizes of upwards of 1 lakh or 50,000 at least. Today, it's very common to see loans of even as small as 5,000, 10,000, 15,000 being disbursed in real time. So, one thing is, time to yes is decreased, but, even time to disbursal now is so low that if you just install an app right now, within 5 minutes, you'll have, whatever your loan in your bank account. All this has come about with the usage of, ML specifically, but also AI, as you mentioned, for let's say KYC purposes. Today we are able to do video KYC or non-face-to-face digital KYC where essentially a model is taking two pictures. One perhaps from the Adhaar and the other a selfie, and matches to tell the system whether there is a match, whether this is the same person who he or she claims to be. And what we've seen that we've done earlier we had this product of face match as one of our portfolio products, and we did an analysis to see how well does it work. So we had humans looking at pictures, matching them, and we had the model matching them. It turns out the model does a better job because in Adhaar pictures are 5, 10, 15 years old pictures. Maybe a human might not even recognize me from this picture to to the current form, but models don't go wrong there. So this is a great differentiator that has already come in. However, that doesn't mean that we are there and AI ML is being used to its fullest. I'd say it's in Pareto, but in the sense that only 20% of the overall lending, India being such a large country, is currently being driven through AI and ML. Hopefully, in the next few years, it will become 80-20, as my fellow co-founder Rajat was also mentioning in the keynotes. Some of the points already covered. We've seen firsthand when we work with multiple lenders and some of we power some of their underwriting through alternative credit scores. we've seen, a huge change in the quality of business and quantity of business, which means that, if for a typical consumer durable, business, from the incoming population, the approval rates were, let's say, hovering around 40%, with the NPAs around 5% for a lender, for a, let's say, not a super mature lender, but maybe in the initial stages of the business. That was based on underwriting, based on credit bureau and, typical banking information. When they added alternative scores to the equation, they were able to just, make the approval rate from 40% to 60%. That's a 50% increase. And at the same time, the NPAs reduced from 5% to, let's say, 2.5%, 3%, which is just like a massive change, where, credit risk professionals would fight and struggle a lot or make a lot of efforts to get even 5% relative change in the portfolio quality. This is a massive jump, and this is what is the capability that is on the table. It's upon the industry to build comfort, including the regulators to build comfort, to adopt more and more explainable form of AI in their credit decisioning, and take this 20% of the decisioning to 80% or higher.
So obviously, yes, enrichment actually helps a lot in your overall model. Data enrichment, it's all about data at the end of the day. If your data is good, obviously the output will be good. So I was talking to Shardul some time back, so the volume is huge. But as the volume of data increases, the quality of data decreases. And where we actually add value is how can you make that quality good for the data so that the end results are good. I remember doing one of these exercises with the bank, I won't name the bank, where we used to do deep learning for understanding whether the signatures are fraud or not. So when you apply for a check, you put your signature and give to the bank. There are cases where a lot of people forge the signatures. Now, the point here was, how do you find out whether in real time, when the data is coming, the two signatures are same, right? And there's a lot of work which happens in the background. So as you said, a lot of deep learning models go behind it and try to understand stuff like that. Yeah, absolutely, absolutely. So operationally, how does AI empower decisioning leveraging real-time data? Shardul, this question goes to you. How seamless do you orchestrate the enormous real-time data in your environment?
Yeah, hi, thanks. So first of all, I know this is a handicap which you carry, as a speaker when you are in the last sequence. So most of the aspects which I'm going to talk are possibly touched upon by my colleagues over here. So to begin with, I'm a firm believer of the fact that, there's this tagline, data is the new oil. Now just think about it, right? With so much of records getting digitized and data democratization which is happening, I think we are at the epitome of a big digital revolution here. And it's going to completely transform the way the traditional underwriting or the risk management has been happening. So like Sachin and I think even Nirav mentioned, there are so many data analytic tools today available in the market which enable a financial institution to actually estimate the lifetime value of the customer even before the account is onboarded. Now, what does this mean? It's like, predicting the future, which is magic. But it's not magic, it's just artificial intelligence, right? So just imagine that if at all at the time of onboarding, if I'm able to estimate the ROE, expected ROE on an account, as an institution, it enables me to appropriately risk price, to estimate my losses, to make provisions, and also to kind of, stitch in my cross-sell strategies around that customer at a time of onboarding itself. So all of this is a massive shift which has happened, over these years with this AI which is coming into place. Today, as again Nirav mentioned that, there are a lot of fintech companies. I mean, my colleague here is heading one of them. And a lot of new generation NBFCs, HFCs, we are doing a lot of stuff in the new to credit or thin file customers, right? And these are segments, large masses, which are completely deprived of the, your traditional banking because of inadequate formal income documents and banking. So I think there's a lot of stuff which is happening on these overall financial inclusion programs through these tools. We have application scorecards or behavioral scorecards, which help the underwriters or the collection managers, for that matter, optimally strategize their, whether it's underwriting a customer onboarding or even for that matter, optimal allocation of accounts. Because they are in a position to, there's so much of this, and these tools which keep on, there's a machine learning. So, these tools keep on enriching themselves as the data flows in. So over a period of time, these people are also able to, kind of predict how the flows would look like, and then the strategy builds around it. So all in all, I think and I still believe that we are just scratching the surface. So there's so much action which is happening over there that it should take us to the next level.
Absolutely.
Next 3-4 years should be solid. Yeah.
Sure. So Saurabh, how has AI-based initiatives improved your time to market? That's a key word, time to market. Because there are so many players in the market right now. How fast can you go to the market to sell your products, right? So how has AI-based initiatives improved it? And how has it helped you eliminating cumbersome manual processes, including manual credit scoring?
Yeah, hi, good morning, everyone. So just before I get into that, my opinion is very simple. I think what AI has been able to do for us is to make the process of credit risk management shift from a process of elimination to a process of inclusion. Now, earlier there used to be a person sitting with a bunch of files, looking at a bunch of documents and saying, if this document isn't there or if this possible information is not there, we just need to exclude this credit out of our credit that we give out in the market. What AI or what data crunching or data association has been able to do is that it has been able to give alternatives to this person to make that particular decision. Now, these alternatives can be used in various different formats and manners. A journey of a customer through, let's say, any financial institution or any bank happens to be divided into 3 different parts. The first one happens to be you onboarding the customer, which is you doing your KYC and knowing your customer, as well as trying to figure out who the customer is that you want to kind of onboard. Second portion is you taking a credit decision as far as asset customers are concerned. And the third portion is basically your disbursement and your collections. Now, disbursements and collections, India is the leading country at this point of time in digitization. We have too many modes of disbursement as well as collection. So that's a portion that we can keep outside of this discussion. As I said, since this process has now become a process of inclusion, and there are a lot more decision tools which are being made available to a person who wants to take a credit risk decision, it has, number one, improved or focused a financial institution on deciding that we are not going to carpet bomb the market. We are just simply going to focus ourselves to where exactly do we want to go and select our customers. Those associations today are available because of the data which is available in the market and the tools that are available in the market which can do those associations, right? Just yesterday we were trying to launch or discuss the launch of another product, and what an association that comes out of the data that you look at simply talks about the fact that the lower the ticket size, the bad rate association with that is that if you have a lower ticket size, please have a lower tenor. Now, the moment you start increasing tenor on lower ticket sizes, the bad rates kind of start multiplying. Now, that's an association which is available as far as when you start looking at bureau data and things like that. What do you do with it is what you need to decide, and how exactly do you need to use that to basically go and select your customers is what helps you to be faster. So today, I'm not going to go and have 10 files and then decide which is the one customer that I am actually going to onboard. I am simply going to decide which of the 10 customers which meet my criteria, I'm going to go onboard those customers. Second, I have the ability to be able to onboard that customer faster because I've already decided which is the customer of focus and I know how exactly to go about doing that. A colleague of mine basically touched upon how exactly can you do KYC faster and things like that. So those are tools which are available. Second, as far as your credit decision module is concerned, you're basically being able to take those decisions faster. One, because of the fact that you've pre-decided which is the customer that you're going to be onboarding. And second, because of the fact that all of these associations are now being made by a machine which is not only providing you faster timelines, but it is also providing you alternate sources of taking a credit decision. Absolutely. Now, this is what has actually made the process better.
Absolutely. So, Mr. Raghavan, the next question for you, it's an interesting one. So, how has AI-based initiatives reduced the credit processing time? Acquiring a customer is what he mentioned right now, but processing time, how has it decreased?
Considerably, if I'm to say so. I already discussed on that some time back. The processing time which was taken for a small ticket size loan, I'm talking about small ticket size is anywhere between 25,000 to 60,000, okay, which was around about 11 days for in our company earlier, is right now reduced to around half a day, okay. Wow. So this is one thing, so you can imagine what it is, okay. I don't want to go much into that, but in simple terms, the TAT has come down a lot. Now, one of the most important challenges what we faced as a microfinance company has been that the skill set. Okay. Now, we are talking about using the application fine in the head office and other things is fine. But how in the field? Most of our employees are undergraduates. Number two, the customers are practically women customers, and most of them are illiterate or semi-illiterate, we can say that way. Okay. Now, how to teach them all? That has been a challenge. In fact, that is one thing which is, that is why I said that we are not fully digitalized to that extent. Sometimes for the customer, we may have to do everything. We may have to take their mobile and then do whatever we want. That is not the way we intended. The financial inclusion intention is that the customer has to do everything. To that extent, it has not gone. Probably we are successful only to 40 to 50% to that extent. Okay. So that is one important thing which, and we have been doing training not only for the staff, but also to the customers, how to go about this. Okay. This is, I'm here talking about, for a 2,000 crores of loan portfolio, we do have customers of around about 6.5 lakhs. Okay. So this is not a small thing to teach this sort of people. That has been one of the most important, difficult things, but we have been able to manage it with all in-house. It is not, nobody has been taken from outsourced to do the training and all that. We are doing it on our own. Okay. And in 9 states we are operating, and 9 states we have put up people to start, and especially we need local language all to do all these things. So to answer to your question, that has come down very much. The processing time has been good. As Saurabh was rightly saying, more than the elimination, it is a part of inclusion what we are doing. But having said that, I would say one more thing. The TAT is okay at this thing, and our dispersals have gone up by 50%. Having said that, the rejection ratio is also equally 50%. Okay. Okay. So, but right now what we are doing is that earlier we were rejecting after 10 days. At least on one day we are saying that you are not eligible. So to that extent also it has helped out. So this is where they have played a very important part. Long way to go, but still a lot has been done. Okay.
Thank you so much, sir. Shardul, coming down to key aspects of automation, how has it minimized or cut down the risk of fraud substantially and systematically?
Yeah, hi. So if we look at it, even less than a decade back, how this fraud risk management was being carried out traditionally, right? So primarily it pertained to, let's say, the documentation frauds, right? So we used to rely on some young boy who's empaneled with a RCU agency walking into the credit chamber, flipping through the files, and he would use his individual judgment to decide whether a particular paper looks suspicious or not. Now, if he says it's a okay paper, then the underwriting team or the risk team would go ahead and disburse, saying all is well, all is well. There's that blind reliance. And on the other hand, if this guy picks up a paper and says that it's a sample, it looks dicey, we'll wait all along for him to give a report saying either it's positive or negative. And the worst was if he gives a refer, saying, I don't know, you take a call. So again, you have to take a judgmental call. So that's typically the way, the documentation risk, fraud risks were carried out. Now you look at it now. So entire KYC as an aspect is fully digitized. Your income documents, your bank documents, whether it's a GST or your ITRs, can be digitally fetched right from the source itself. So the question of these documents getting fraudulent or tampered is significantly minimized, right? Rather, it's eliminated, you can say, if somebody is using those platforms. The other kind of frauds which we used to face was in terms of identity thefts or signatures getting forged, where again we have e-signs in place, we've got biometrics in place. So there's a long journey which has happened on that course as well. So with e-stamping, e-signs, and even the documents getting digitally created and signed, a lot of that element is also taken out. So I think on the retail finance side at least, there's a lot of progress which has already happened in this segment. Maybe some of the areas which I feel are still open are one. So while my colleague mentioned that there are these desktop valuations and all which are there, so there is a bit of work which is happening on the valuations. But if I was to talk from the mortgage side, where do I lose money? If I go wrong on the valuations or my collateral. So that's one piece which is still kind of not fully organized, and that's sheer because of the demography of the country and market specific nuances. It's like even when it comes to valuation, it's like you look at a flat in Mumbai. If from one of your windows you are able to see the Worli sea face, your rate per square feet goes up. I mean that's the way the crazy valuations happen. So I think valuation is one piece where some stuff needs to happen, and similarly on the legal side. So while there are a lot of land records which are getting digitized and all, but we still in deeper markets we run the risks of multiple fundings. So I think those are some things where work needs to happen, which I think the regulators are working on it. There are a lot of players who are already working on digitizing these things as well. Maybe next 5 years down the line we should be able to cross that. But on the retail asset side, I think we've come a long way. There are other kind of frauds which are emerging on the liability side. You talk about your ransomware attacks, your cyber crimes, your phishing and dark web and all of that stuff. So I think that's a big one which is emerging right now. So that's the way I look at the landscape. Yeah.
Thank you so much. Sachin, how is your organization working towards improving the explainability of your AI models? That is a big piece now because RBI is mandated that you have to make sure that your models speak out what it has to speak. Just a black box model, you just go and say, this is the reason I took a customer. It becomes a little challenging now. So how does your organization work towards that, which provides a clear understanding of AI-based credit risk models? So how do you make sure that your models are actually explaining what it's supposed to?
Sure. So let's look at it this way that artificial intelligence always needs to have data patterns detected, right? Those data patterns are detected and interpreted, and therefore their outcomes predicted with the help of models. Models can be various natures and types and to various degrees of complexity, and therefore various degrees of transparency, right? I mean, the more simple it is, the more explainable. The more complex, that's where the explainability factor goes down significantly. And clearly, there are areas where you would typically use more simplified models, like a regression-based model, right? Whether linear, logistic, polynomial, so on and so forth, which are fairly explainable because there's a finite or a restricted list of features or variables. Those have been decided upon basis some clearly documented and demonstrable backtesting, and therefore have a predefined weightage, and for that, every application which goes through it or every data set which goes through it is rank ordered in the same manner. Unlike that, you have, you could move to a next degree of model complexity where you would have the likes of, the random tree, random forest decision trees kind of a model where it's a web of decision nodes, right? I mean, it spreads across. The variables are multiple fold of what you would typically have in a regression-based model. And therefore, that itself increases, if you look at it, decision nodes, webs, spreads to a very large branch at times. And that itself makes the model complexity and explainability difficult. The next level further comes on when you go to, models which are ensemble models, right?
Correct.
Where you take multiple model types and you basically create a bouquet of models, and you use certain techniques like boosting, bagging, and therefore get the best out of all the various techniques of modeling. And that is further blacker in the box, if you were to call it. So given that, there are various degrees and complexities, and depending on the predictability and the requirement, right? First factor would be the requirement. Second factor would be the predictability power. But interim, how much of data enrichment and data quality you have, right? And how much of decision science talent you have, right? And what kind of tools you have, all of them determine as to how complex a model you can build. Either way is all said and done. What we do is that we follow this approach. Right? When it comes to certain areas where simplistic models work well, right? But certain areas, modeling requires far more sophistication. And there, the explainability can be brought in, especially now, both from an internal consumption perspective, because ultimately AI needs to be monitored. Else you will never be able to figure out whether it is a bias, where is it going, is it giving you...
Exactly.
Right?
Exactly.
So tools like SHAP values, right, are nowadays pretty much able to largely explain what are the most significant factors in black box models, which are shifting the probability of default or the PD score. And that's what, an approach like this or other tools also can be used, which leads to discoverability of the key moving parts, not all the moving parts in a black box model.
Sure. So I think we have less time. So still, I'll just ask some pertinent questions on what are the pros and cons of AI-based credit risk management. All people say good about it, but having said that, it has its own flaws too. So what do you think, according to your experience, would be the pros and cons of having an AI-based approach?
Pros and cons, before coming to pros and cons, basically challenges. So to pick up from a word which Shardul used, which was magic, and then what he used, which was rejection rate. Just an example, maybe centuries back, when there was a huge illiteracy, lack of knowledge and information. For any kind of problem, starting from infertility to financial to behavioral, we used to go to priest, mandir jate the pujari, because he was the only person who was having knowledge, according to everybody. And he would give a solution, and people would follow. So biggest risk that I see the illiteracy in terms of other fraternities other than technology and data science to understand technology and data science. So what we do today is any problem in business, go to a data science guy, AI guy, ask for a solution. So it's a high time that the knowledge about data, the statistics, AI tools, algorithms, it's not only for the IT guys, it's for everybody who are using it. So the literacy to be increased. So that is the challenge. I think, according to me, that is the biggest challenge. So I'll stop to that in interest.
Sure. Yeah, so another 2 minutes left. So Nirav, what according to you would be the major AI risk and challenges involved? And at the same time, how do you think the risk management has evolved along with AI? Has it evolved the way it should, or you think it will still take a long time till it becomes a little stabilized way?
So definitely, I think Nirav has already covered most of that part. So the challenge is like you get a lot of information, but how to use that? So that is very tricky. So obviously, every bank is having some data analyst or some name people have given actually. So now it is moving slowly from IT to maybe risk side also, credit side also, and somewhere it is independent also. But still, my challenge is like, it's like that you are running on a highway because everybody is putting a lot of numbers and highway people say that speed thrills, but it kills. So something of that sort, like people have started that, okay, small ticket size loan, 50,000 will do in 5 minutes. Then people have moved to 1 lakh, 2 lakh, even some people now in 5 lakhs also. Now, if I talk from the traditional banking point of view, how many people will really comfortable to just based on data or some information to take decisions? So I think some ground level information, some meeting to customers, so that we should not ignore further. Or maybe if not 100%, do it some on a sample basis, 50%. So monitoring, collection, integration, that is all an integrated part of this. Exactly. Going purely based on some information, because everybody knows that as informations are coming, there can be a lot of misguided information also. Maybe that we are reading it wrong or maybe we are getting it wrong. It can be either way. So you can't blindly go with these kind of models. Even for a small ticket size, like people have already burned their hand actually, small ticket size. So a lot of clusters have given problem, a lot of fake accounts have opened. So there are a lot of many things people, especially NBFC side, people have burned their hand. So I think we need to be little careful when we are doing blindly this thing. So some oversight is very critical on this part. So although like today job of chief risk officer is not like only to stop the business, it is like I'm also the person who has to be a target. But only difference between a business head and a chief risk officer is like, I will only talk about good growth. He will talk about that, no, I have the numbers in mind. So that is the only difference. So that some kind of combination is required for that.
So I had far more questions actually, but then I think it's already 1 minute over time. So thank you so much, gentlemen. It was a pleasure talking to you, sharing your experiences. When I compare myself, I've done nothing compared to what people have done. So it's always been a pleasure talking to you. Thank you so much for your time. Thank you for your patience and making up to this event. I'm sure we'll have far more events today, and we can exchange more ideas. Thank you so much. Thank you so much.
Thank you so much, panel members, and thank you so much, Sreejay, for wonderfully moderating the panel. I would request the panel members to kindly stay on stage, and we would like to call on stage Ms. Priyanka Gaikwar, Associate Director, Data Analytics from Altair, to kindly do the honors of felicitating this wonderful panel. We'll start with Mr. Shardul Kadam, CRO from Fedbank Financial Services first. Thank you, Priyanka, for doing the honors. Ladies and gentlemen, Mr. Shardul Kadam, CRO, Fedbank Financial Services. Thank you so much, Shardul, for your wonderful contribution in the panel session. Moving next, Mr. Sachin Bawari, Head Risk Lending Business from Khatabook. A big round of applause to Sachin for his wonderful contribution in the panel session. Moving next to Mr. Saurabh Srivastava, Head Credit Risk from Unity Small Finance Bank. A big round of applause for Saurabh for his wonderful contribution in the panel session. Mr. Anant Deshpande, ladies and gentlemen, co-founder from FinBox. Thank you so much, Anant, for your wonderful contribution in the panel session. Moving next, Mr. Srinivasaraghavan, CRO from Arman Financial Services. A big round of applause to Mr. Srinivasaraghavan for his wonderful contribution in the panel session. Mr. Alok Pathak, ladies and gentlemen, CRO from Utkarsh Small Finance Bank. A big round of applause, and thank you so much, Alok, for your wonderful contribution in the panel session. Mr. Nirav Shah, ladies and gentlemen, CRO from Adhaar Housing Finance. A big round of applause, Nirav. Thank you so much for your contribution in the panel session. And our honorable moderator, Mr. Sreejay Sridharan, Associate Director for Data Analytics from Altair. Thank you so much, Sreejay, for wonderfully moderating the panel session. Would request all the panel members to kindly step forward with Sreejay and Priyanka, if you could also join them for a group photograph. So, ladies and gentlemen, this was our first, and what a cracking panel session of experts we had on AI for credit risk management, banking and finance companies. Once again, Mr. Shardul Kadam from Fedbank Financial Services, Mr. Sachin Bawari from Khatabook, Mr. Saurabh Srivastava from Unity Small Finance Bank, Mr. Anant Deshpande from FinBox, Mr. Srinivasaraghavan from Arman Financial Services, Mr. Alok Pathak from Utkarsh Small Finance Bank, Mr. Nirav Shah from Adhaar Housing Finance, and our moderator, Mr. Sreejay Sridharan from Altair.